Hello and welcome. I'm Saeed from StoryPlanet.net. Dive right into the essence of the most captivating books without reading them cover to cover. Whether you're on the go, at the gym, or just relaxing at home, we offer you a unique and enriching listening experience. Today, we are exploring the book, Common Stocks and Uncommon Profits and Other Writings, a creation by Philip A. Fischer. Common Stocks and Uncommon Profits equips you with all the essential knowledge required to make intelligent investments, regardless of your investment approach. Whether your goal is to maximize profits or safeguard your current funds, this book charts a clear path towards achieving success. Before we delve into these revelations, it's interesting to note that Philip A. Fischer, a pioneer in investment theory and the creator of the esteemed money management firm Fischer & Company, wrote the influential book Common Stocks and Uncommon Profits in 1956, which has remained in publication to this day. With 8 key ideas to unveil, brace yourself for a deep dive into this captivating book on StoryPlanet.net. To start, discover the secrets to successful high-risk and conservative investing. The book, Common Stocks and Uncommon Profits, offers advice on investing that is still relevant today. It highlights key characteristics to look for when investing and helps determine risk tolerance. Successful investors do their homework and gather relevant information before investing. The book discusses how to determine if a stock is overvalued, why stock price doesn't indicate the quality of a company, and how to overcome doubt when making investment decisions. Key idea number 1. Smart investment strategies prioritize companies that have strong potential for long-term growth. Smart investing involves long-term thinking and planning rather than seeking quick profits. Smart investors look for undervalued companies with growth potential. Companies with growth potential have products or services that can sustain high sales volumes for a few years and invest in research and development. They adapt to changing markets and have solid management and good employee relations. Key idea number 2. Before investing in a company, it is crucial to thoroughly research and analyze it from various perspectives. Doing your homework helps you gain a comprehensive understanding and make informed investment decisions. Successful investing requires thorough research and analysis, much like the work of a detective. To evaluate a company's investment potential, collect detailed information from multiple sources. Avoid relying solely on traders, as they may have their own interests in mind. Use the scuttlebutt method to gather information from vendors, customers, former employees, and industry experts. Contacting competitors can also provide accurate insights. Develop a profile of the company before directly contacting management with informed questions. Choose companies to research carefully based on growth potential. Avoid wasting time on companies with negative news or questionable dealings. Key idea number 3. To buy stocks at a lower price and benefit from future growth, look for opportunities when the stock price dips. When looking to invest in a company with long-term growth potential, it is important to consider the fluctuations in stock prices. The financial community's perception of a stock's value can lead to overvaluation or undervaluation. This creates a cycle where people rush to buy when a stock is perceived to be high, causing the price to continue to climb. Conversely, unexpected expenses or problems can lead to downgraded projections and a decrease in stock price, even if the company has future profitability potential. Recognizing this irrationality can lead to extraordinary profits. Companies with growth potential often face challenges that cause the financial community to undervalue their stocks. This presents an opportunity to buy at a lower price and profit when the company resolves its issues. If missed, there may be another chance to buy during future dips. Key idea number 4. Trust your own judgment and don't let doubt or the opinions of others sway your decisions. Avoid following the crowd when it comes to investing. Doubt is natural, but successful investors have no room for doubt. Don't hesitate when you've identified a company with profit potential, even if the crowd is not jumping on board. Buying when everyone else is selling can be scary, but it may be a golden opportunity. Don't wait for the stock price to fall further before buying, as you might miss out. Once you've found a good investment, Hold on to it unless there are valid reasons to sell. Companies with huge growth potential can never be overvalued. Key idea number 5. Conservative investors should focus on finding stable companies that are well managed and have the potential for growth. Conservative investors should look for large, established companies with a proven track record of profitability. These companies should have potential for growth to maintain market position. The key characteristics of a strong and growing company include low-cost production, effective market organization, a track record in research and development, and financial know-how. Key idea number 6. Employees are essential for the success of a company and should be considered valuable assets and investments. Examining a company's treatment of its employees is important for conservative investors. The growth potential of a company depends on its employees, and how they are treated reflects overall productivity. How promotions are handled and the ability of managers to work as a team are indicators of how a company values its human resources. A company that does not prioritize employee development and teamwork may not be a wise investment. Key idea number 7. Conservative investors seek companies with long-term profitability. A conservative investor should evaluate a company's future prospects and profitability. Profit margins are more important than total returns. Profitability is crucial for long-term growth and to finance future expenses. Being better than the competition and having scale can ensure market dominance. Technical developments that are legally protected can also secure a company's position. The company's strategy should consider long-term development. Key idea number 8. To determine if you are paying the true price for a company, calculate its price-earnings ratio. This ratio helps assess the company's value in relation to its earnings. It is calculated by dividing the market price per share by the earnings per share. The value of a stock is subjective and varies from person to person. Risky investors may value stocks higher if a company is expected to grow rapidly, while conservative investors look for stable, undervalued companies. The price-earnings ratio can be used to determine a stock's value by dividing the stock price by the earnings per share. Higher earnings may lead to an increase in the stock price, but conservative investors must consider if the company's characteristics justify the market's belief in future growth. In conclusion, to be a successful investor, you need to look beyond a company's stock price. Digging deeper into a company's true value can lead to great rewards. If you're having trouble finding information, try reaching out to your bank for introductions and insights. Be clear about your intentions and treat the information with discretion. Thank you for listening to this summary. If you enjoyed this exploration, we invite you to discover other fascinating books on storyplanet.net. Don't wait any longer. A multitude of books, stories, and knowledge await you there. See you soon on storyplanet.net.